We are live. How to get rich in 2022 while everyone else is going to the poorhouse. Buy these 4 stocks now before it's too late. Pick number 1 is a play that energy prices will go higher and higher and higher as long as there's a conflict in Europe. And unfortunately, US is thirsty for blood. This is a look at the dependency on natural gas from Russia. And so this is going to be their number one way to fight back against sanctions is cut off natural gas. Russia makes all their money on the oil, but the natural gas is really the choke point to inflict serious pain on their foes. And so while US media make you think Ukraine's doing so great, it's not working. We can see the ruble is hitting a new high against the dollar and euro as their exports are booming. Pick 2 is a play that interest rates are about to collapse due to a monumental fall in GDP from China lockdown, from interest rates rising, and also from a lack of stimulus. So we're expecting a slowdown in global economies. And it's really, there's 2 outcomes to get these rates down. Either the rates crash the global markets just on their own, or these energy costs come down. And either way, we're looking at interest rates most likely following the 40-year trend to zero. And these central bankers are nuts. They are designing strategies to push interest rates negative with digital currencies. They want to make it so your money evaporates and they can control you in every step of your life. So get ready for it. We're going to bet interest rates make new lows over the next several years. Pick 3 made a 20,000% return in its first 5 years, and I believe it will go up at least another 400% in the next 3 years. This is Microsoft of the decentralized world. Okay, so the big revolution of the last 50 years was creating centralized databases and technology surrounding that. And Windows was the big operating system that made this all possible with Mr. Bill Gates. Now we've got a new 20-year-old who's a little genius creating the same technology, but without a centralized authority. So I look at Ethereum like buying Microsoft when it was 5 years old. It's going to take decades for Ethereum to hit its maximum potential. Pick 4 protects your account against a stock market crash. This puppy went up 1,000% in the March lockdown of 2020. Today it's up 9% with Boyle. So 2 of our plays are up 9% each. Our Ethereum plays down 4%, and our Treasury plays down 2.6. So we've got 2 of our positions up 9% and 10%. The other are down 4 and 2. Here's a look at that crash insurance that delivered massive gains in March. So the way this works, it starts off slow, and it doesn't completely cover your losses at first. So when there's a moderate crash, and I wouldn't say today's a moderate crash, we'll talk about this crazy volatility we've had all week. But it's really when the market gets into complete panic acceleration to the downside that this thing goes skyrocketing up. So if we look at that March crash, just check it out. The first 2 weeks, UVXY only went up 300%. But in the next 2 weeks, it screamed higher, an additional 700%. And we'll look at the futures of UVXY, and it's now in the shape we need to make some serious money. Amazingly, it was barely up in the beginning of the sell-off today. It's finally starting to get people covering their short VIX positions. So do yourself a favor, put as much money into this portfolio of 4 stocks before you miss out on massive profits in the weeks ahead. And again, this portfolio probably doesn't have a single position that you've had in your portfolio before you came to this webinar. Maybe you've got some Ethereum. I highly doubt you have a triple leveraged bond play. I highly doubt you have a leveraged natural gas play. And I'm sure you don't have the crash insurance play. And most of you probably don't even have the Ethereum play. So it's a very unique portfolio. It's up 35% year to date. People are getting taken out to the to the barn here and spank this year. It's been a really rough year for investors. Our strategy is really working well. So last year we had the same strategy, almost identical. Instead of betting on natural gas, we're betting on the US oil and gas companies, and did very well with that. And the big change this year is we switched from oil to natural gas as a better potential profit when we realize what Russia's likely to do if this continues to escalate. And unfortunately, it sure as hell is about to escalate. And then we added bonds to the portfolio because that bond market crash is historical. You won't see opportunities like this often. So let's take a look at how we would put $10,000 into the market. And if you got more, just multiply it. Step one, buy your crash insurance, 67 shares of UVXY. Here's a look at UVXY. We've not changed the position this year. It's gone up, double, pulled back, and it's popping right back up. There's a lot of uncertainties in the market, and this has been doing a decent job to help reduce that volatility for us. Step two, buy 144 shares of TMF. This is the 3 times 20-year Treasury bull. Okay, and our bet is that at the end of the day, interest rates have to go lower. Okay, this is extremely good buy for treasuries. We'll cover that in more detail. But historically, this is not only the greatest decline in treasuries, it's also the longest bear market we've seen in history. And this is due to the overshoot in inflation that has caught the world by surprise. Now, it's my expectation that we've hit peak inflation. It's going to now fall. So we'll cover that. But that's really the big prediction we have for this year. Last year, we predicted the exact opposite. So we predicted that the exact opposite. Okay, so here's a look at the TLT. Now you can see this is one of the worst drawdowns on the TLT in history. And yeah, so we told you guys we're buying it at 125. We don't care if it goes to 120. If it goes below 120, we want to add. And so we are sitting at 119.78. I do expect a trade alert next week, so stay tuned. Step three, buy 169 shares of ETHE. That's our favorite growth asset. This is growing faster than the internet. The reality is Ethereum has grown its user base faster than any technology in history. Okay, so this is a very fast growing ecosystem. And to simplify how you think about it, it's an operating system that's competing with Windows, and it's allowing people to develop applications to replace everything that you use. So imagine a Twitter that was decentralized, no censorship. Imagine a Coinbase that was decentralized. Well, guess what? It's called Uniswap. It already exists. They've replaced the loan system with Aave. So just beautiful. We can go take our Ethereum deposit and take out an 80% loan for peanuts. I'm talking $1 origination fee and a 3% interest rate. You don't have to go to the bank. You don't have to have a credit score. You can go borrow money on demand using your collateral. It's a beautiful, beautiful product that is developing rapidly. This is our growth asset for the future. And some things you should know, even though the US is tightening monetary policy and freezing new spending due to inflation, other countries are not. Japan is printing like crazy to do yield curve control. They do not want interest rates on their bond to go over 0.25. And so look what's happening to their currency. Massive devaluation. They're willing to print an unlimited amount of money to keep that bond market intact. China now printing to protect their real estate market. And guess what's happening to their currency? It's weakening. So in general, here's where we're going to expect Ethereum to skyrocket up. To be holding its ground right now with the dollar rising so rapidly is impressive. But my main expectation is that the second energy prices fall, so will interest rates and the dollar, and you're going to see growth assets skyrocket up. So we've been fighting a rising dollar for the last year, and that's been a huge headwind against cryptocurrencies. This strong dollar is going to tear apart and rip to shreds the rest of the world, and eventually become a huge problem for the US itself. So I do believe we are very close to peak dollar valuations and likely a dovish surprise next week from the Fed. So we'll talk about that important monetary decision next week. When the dollar falls, expect cryptocurrencies to leap to new highs quickly. Step 4, until that happens, we need to hedge against a more expensive dollar and higher energy and interest rate costs. That's why we've been long energy since last year and into this year. 38 shares of Boyle. And here's a look at Boyle. We did pull half our position off the table for a nice profit, and we're getting ready to pull more profits off soon. At this point, we're not making any changes. A lot of questions about should we do this or that. If it's not in the trade alert, we shouldn't do anything. So once again, we've not changed the portfolio, so you should not be changing your account. Here's a look at the breakdown of the portfolio. We have in a $10,000 portfolio, you'd be buying 67 shares of UVXY. It's coming in at about 11% of the portfolio. The percent is going to go up or down every day. We are not chasing 11%. You need to only follow the ratio of shares and wait for your trade alert. Okay, so on the defensive side, we're betting on deflation, and that is UVXY with 67 shares, and it's TMF, US Treasuries with 144 shares, coming in at about 21% of the portfolio. So right now, 32% of the portfolio is essentially hedging us against our inflationary bets. Now, on the offensive side, we have two polar opposites. These two will tend to go up at opposite times. That's why they're almost equal weighted right now. We have Ethereum, ETHE, the Grayscale Trust. You can buy it in your stock account with 169 shares, coming in at 35% of the portfolio currently. And then we're hedging against its main risk, which is energy costs going up, which indicates interest rates are going to rise, coming in at 38 shares. So I believe we're coming to a boiling point, no pun intended, in the war, and there's going to be a good opportunity to sell Boyle and rotate that into one of two plays. If Boyle goes up to extreme highs because Putin is cutting off energy costs and is trying to collapse global economies, we're going to rotate that money into UVXY and TMF. On the other hand, if we're on the verge of Ukraine surrendering and sanctions rolling back, we're going to dump Boyle because it's going to crash, and we're going to rotate it into FNGU, betting that supply chains are going to get fixed, and we want to go back into some of the best technology companies and diversify out of only being in Ethereum. So we got to realize bond market's now on the verge of crashing the stock market. So if Putin really wants to screw with global economies, shut off natural gas, jack up those energy costs, make inflation go soaring, and just demolish the bond market. It's already at a critical level. And most likely the Federal Reserve is going to have to be very careful about monetary policy decisions Wednesday coming out, which could really make or break this market. Now, the 2-year bond is saying they're going to jack up interest rates rapidly every meeting. We're talking 50 basis points Wednesday, 75 basis points the next meeting, 50, and then 50. So that'll get us up to 2.5 total on the neutral rate, with the 2-year at 2.7. Okay, so what we're going to expect is they start jacking up these interest rates. The 2-year needs to fall and tell the Fed that, hey, okay, we're starting to believe you're going to get control of inflation here and not make you crush everything under the sun. So 2-year is telling us some bad news is coming from the Fed. We'll see exactly what they do on Wednesday. Yields and energy prices cannot remain at this level. If they do, they will crash everything around it on their own without the Fed having to even lift a finger. Here's a look at the energy costs this year. And so we can see this coil setting up. If we increase sanctions, expect this to break to new highs. If we decrease sanctions, I expect this to fall to a much lower level, probably in the 80 to 90 range, where I would then get us back into NRGU. But it's hard to predict what the hell these evil politicians are going to do next, right? Here's a look at energy costs over the last 3 decades. And so, yeah, they can go to this level. They will not stay up there for long. It just crushes the economy. So the second the conflict ends in a positive way, we're going to go long FNGU. If Putin weaponizes oil, we're going to go long UVXY and TMF. And that is really the plan at this point in time. Here's a look at FNGU. It's 12 triple leveraged tech stocks that are all beautiful companies long term, 2 out of China that I'm very bullish on, and then 10 in the US. So you combine FNGU with ETHE, you're really betting on the future here. Those are our favorite growth assets with leverage. Now, the last time the US went into a tightening cycle, while China expanded credit, was 2015. They almost crashed their real estate market. Funny, that's exactly what's happening now. 2016, they went into a credit expansion as the US tightened. And from 2016 to 2018, Bitcoin went up 4,400%. Now the catch is, this was when the bond market started having a lot of trouble, and they started talking about quantitative tightening. And so if you know what happens next on this chart, Bitcoin crashed, then emerging markets crashed, then Europe crashed, and then eventually the US stock market crashed. And guess what? Mr. Powell did the famous Powell pivot, dropped interest rates, started printing money. And so this time around, they haven't even begun the tightening process, and markets are flipping out. The bond market's already reset to critical levels. So are they really going to crash the whole global economy on Wednesday? Are they going to come out with something dovish, make the market very happy? Yeah, buy the whole portfolio at once. Don't wait. That's a question from a free trial member. So it's important that you watch every webinar, Monday, Wednesday, and Friday. We've been taking Wednesdays off so I can do more research and content production. But if there is critical information, expect a webinar on Wednesday. Monday, Friday, we've been rolling out like clockwork. And be ready for sell alerts. Now, if you're on a trial, call Dean at 505-322-7515 to upgrade and not miss out on our next trade alert. Okay, we're going to hit our fun little news feed where I retweet interesting comments. Sometimes it's comedy, sometimes it's interesting charts and facts. It just gives us a vibe of what's happening right now. And then we'll go through our charts. And at the end, we'll review our safe growth strategy, which is outperforming the SPY and the NASDAQ, even though it's down, with a very diversified global portfolio that's leveraged. Keep that in mind. We're outperforming the SPY and the NASDAQ using triple leveraged products. Okay, so that one's, even though it's down a bit, still doing great. The high risk is doing phenomenal. It's again up 35% year to date. So we'll cover the exact asset allocation per unit and what we're expecting for trade alerts at the end. Okay, let's look at our news feed. Since 2009, Amazon is up 10,000%, not a typo. Now, Bitcoin's up 3 million%. Along the way, it has pulled back by 30% or so 5 different times, including now. So Amazon had a bad earnings last night, and I think that was what set off the chain effect of selling today. And we got SPY down 3.6 and the NASDAQ down 4.4. Very tempted to jump into FNGU before the war has ended next week. So we'll keep a lookout for a trade alert. I know we did warn you, we might do a trade alert this week. We waited. Good thing we did. We're going to get a better entry point now. Okay, unless we get a bounce this afternoon, the NASDAQ will have its worst start to a year through April of all time. Below are the years where we closed down over 8%. Okay, so I'm very, very tempted to actually start building into FNGU Monday. We'll see. No promises, but that's what I'm thinking. I almost did this Monday. I waited. I'm glad we waited. Okay, Savon Henrik says, show me the time when the Fed ever raised rates with the NASDAQ in a bear market. Let's look at this chart. Okay, so in red, we got the NASDAQ, and then in blue, we have the federal funds rate. And so the dot-com bubbles when they did it. So the dot-com bubble, the NASDAQ had started to fall, and they started jacking up interest rates. And then the sell-off was too hardcore and they ended up reversing. So that's really the only time we can really say that they did that. But it's become a political issue to get the inflation down. So the big question is the inflation peaking and getting ready to fall? And there's an awful lot of data to suggest that they really don't need to do anything now. The rising energy costs, the rising dollar is crushing inflation already. Equity fund flows, super bearish. This is getting back to some levels that were last seen in the pandemic, 2020. It's probably a very good buying time coming up soon here for stocks. Hang Seng Tech up 7% now on market speculation that China's Vice Premier Liu He will hold a meeting with internet companies after the Labor Day holiday. So for a while today, emerging markets were still up. They still are. They're flat on the day while US markets are getting hammered. Our safe growth strategy has a leveraged play in emerging markets with ticker EDC. It's our single biggest position in that portfolio. Okay, used cars, which have been pushing the CPI up higher and higher, starting to fall in reverse, indicating perhaps a slowdown in the CPI. So Von Henrik says market carpet bombing, GDP growth negative, consumer sentiment in the toilet, savings rate collapsed, inflation 8.6%. Now let's tighten monetary policy, not when GDP growth was 5%, trillions of fiscal stimulus in the system, and inflation already at 5%. So a lot of people were yelling and screaming to raise interest rates and slow down the QE last year when the economy was red hot, and they didn't do it. Now they're having to slam on the brakes, or at least they're talking as though they will. So far, all they've done is raise interest rates a measly 0.25%. Zero hedge, the biggest story of 2022 is that the asset price carnage has occurred before quantitative tightening even started. Bank of America. Some interesting data on the medicine that has been pushed through the TV so hardcore. I'm not going to even cover it. It's not even important right now. Once we start to see lockdowns in China, we know they're all locked down, but that looks like that's about to open up. We got some data on that. More problems with the food supply. Food costs are going to be highly inflationary, probably for the next 2 years due to all sorts of things happening. But the latest headline, more than 24 million birds have been killed in the past 2 months in an effort to contain a flu outbreak. So yeah, we've got wheat problems because of Ukraine. We've got fertilizer costs because of natural gas going up. We've got small farms are being forced to shut down for very odd reasons. We got Bill Gates buying up all the farmland. Very, very interesting things happening in the food supply. Not good. Here's what's priced into futures markets. 100% basis point hike May 4th. And that I don't think will piss off the market. I think that's what they're going to do. I think they're going to go forward with 50 basis point May 4th. That's Wednesday. And they're going to begin the roll off of the balance sheet of 95 billion. And I think the market's going to love it. That's my expectation. We'll see how it rolls out. I'm not so sure they're going to really go through with 75 basis points by June, because we should see energy costs coming down and inflation prints coming down and more dovish surprises. Remember, we're going into midterms, and it's not like they want to create a complete stock market crash right ahead of the new midterm elections this winter. So we'll see. But this is what's being priced in. June 75 basis points, July 50, and then another 50 in September. And that gets us to where that 2-year is trading at. Remember, the 2-year has really designated where the federal funds rate ends up. And it's when the federal funds rate goes above the 2-year that we start to see problems in the market. So we'll be focusing on that 2-year to try to predict the Fed. Jim Bianco says, I believe the era of 25 basis point hikes are over. There'll be at least 50 until the end of the tightening cycle. For the Fed to stop hiking, something has to break, a recession or a bear market. Heads the list. What level will the breakage occur? Has it already occurred? To complicate matters further, the hike table does not account for the tightening effect of quantitative tightening. The Fed is likely trying to assess how restrictive its goal of 95 billion per month of balance sheet runoff will be. Europeans are now starting to pay for natural gas in the ruble. Ruble is going to new highs, which is going to make those energy costs relatively more expensive for everyone. Looks like the panic in China is rolling over. The cases are falling. So perhaps they will reopen up and fix those supply chains, reduce inflation. That's going to make energy costs go back up. But at least we're going to get all the goods and services exported to the US because there's going to be a huge slowdown from the month they've been locked down already. We've got Western nations starting to evacuate Moldova, indicating it looks like this war is going to keep going on longer than we've all thought. Juliet de Klerk says, if you want to know who's winning the war, look at the currency. And again, it's at a new record valuation against the dollar or against the euro. Robert Barnes says, sanctions worked so well, the Russian economy grew in the first quarter and the American economy shrank. Harold Malgrim says, if Putin finds himself at risk of being seen as failing, he may try to up the ante. Right now, I worry his response to Austin and Blinken's promise to flood Ukraine with more weaponry will be application of tactical nukes to force Washington to rethink. The US is not ready for that. Negative GDP growth relative to the federal funds rate. And so, yeah, these are very bizarre conditions to be having to hike interest rates. So it'll be fascinating to see what they do Wednesday. Since 2013, every time the S&P 500 went negative year over year, the Fed either stopped tightening or began loosening. We are now there. So we will see. Let's just see how hawkish they are. But that's the big thing to worry about next week will be what exactly comes out of that. Here's European gas prices just going up, up, up. Now remember, we're playing US with Boyle. There's not as easy to play the European ones directly. So it's just a bit of a delay. The higher those costs go there, the more they export ours, and it drives our prices up. And if this is any indication of whether or not we're about to end the war, Biden's asking Congress for $33 billion and more funding for Ukraine. And here's the Michigan consumer sentiment at the same levels we've had during the 2008 financial crisis. So we will see. All right, let's look at the charts. Here's interest rates. You can see they go down over time. Big question is why? And in general, what I'll tell you is the bigger the debt grows, the more money it costs to service the interest. And so when you have governments that have promised more than they can deliver, and they need to continue delivering these promises to stay in office, it results in them having to borrow greater and greater amounts of money. And that's why our national debt is going up exponentially. So 30 trillion US public debt, 30 trillion private debt. Okay, these interest rates can't stay this level. And meanwhile, they all have to expand debt to stay alive. So my bet is they're going to drive these rates to new lows. Okay, and they have to. That's the only way they can keep the party going. Otherwise, we're looking at a complete black swan event that crushes all assets and sends us into a Great Depression and starts creating revolutions all over the globe. So we are at that critical level on interest rates. And my most highly convicted bet in the next 2 years is that you buy treasuries, you're going to make money. Are we at the very, very, very highest interest rate? Maybe, maybe not, but we're very damn close to it. And so TMF is our bet on that. Here's your TLT, another way to look at it. Okay, so we're at a critical level. We're below a critical level. Okay, so we might do some trading next week. And the two tickers I like are the two that are down the most, FNGU, TMF. We've already got a lot of Ethereum and Bitcoin, so a little diversification really helps. Okay, what about the housing market? Housing market's $150 trillion. These interest rates are rising globally. Okay, it's the same thing. If you don't drive the interest rates lower, the cost of mortgages go up. They're up twice. So you're paying twice the monthly interest, the monthly payment right now, compared to the low interest rate we had. And they drove up the housing sector massively globally. And if these rates don't go lower, the whole housing market's going to start crashing. So it's just it's a phenomenon in the whole financial system. Here's the 2-year against the 10-year spread. A lot of people look at this to predict recessions. We went negative for a tiny split second, started to steepen. Now remember, once you invert, the next 12 months are very bullish for risk assets. And it's when it steepens that we get the crisis. So I'll zoom out so you can see that. Now, but look, it inverts way before the recession. Okay, so it slightly inverted. Now, some people prefer to use the 3-month over 10-year. That one has not even come close to inverting. Okay, let's look at the yield curve right here on the left part of the screen. The 20-year has a higher rate than the 30. So it's inverted on the 20 over the 30. We're inverted on the 7 over the 10. But you can see that 3-month way down here compared to the 10. So there's no inversion on the 3-month over the 10 or any other number. Okay, we reviewed the probabilities of rate hikes, so I'll skip this one. Okay, we got a downward slant on the VIX futures. That's how we make money with UVXY. Specifically, we want the May price to be greater than the June price. And the greater that differential goes, the more money we make. So earlier this week, we were fighting it being slanted to the upward. Now it's slanting down. So UVXY is ready to make some money now with more downside action. The banks are getting destroyed with interest rates going up. Good point, Ed. Ed's asking about FAS. Yeah, that's very problematic. FAS is down 10%. I actually was looking at that one. But in general, we'd be betting on FAS going up if we thought interest rates were rising. They're rising and the banks are crashing. So that's a nightmare. And probably one of the most concerning correlations you could possibly look at. That correlation is broken. So very good point. Yeah, and I'm not going to be pulling that trade alert because I think interest rates have peaked. Okay, reverse repo, 1.9 trillion. So this just keeps going higher and higher. And so why? So you get 0.3 if you go use that. 0.3 for a risk-free way to borrow, to get interest for banks. So the banks are loading up on that, borrowing the Fed's assets to get a safe interest rate of 0.3. Okay, in this chart, we're looking at gold versus copper. They call it Dr. Copper, and this ratio is used to predict interest rates. Now, it's not been very good. If I zoom out a bit, we've had interest rates skyrocketing over this period of time, and gold and silver are trading at par, so this did not work for predicting interest rates. If we zoom in a little bit, they're really just trading at par. So this relationship really is broken. If I go right here, you could say this is arguing that it's predicting lower rates with gold trading above copper. Now, China locking down is going to crush. If we look at the import-export data, China stopped buying stuff at the start of the year when prices got too high. It looks like they're really aiming to drive the import costs down to keep their economy from spending too much money on imports. So, and that's barely working. This chart, we're looking at BOIL versus NRGU. Those are our two favorite interest rate hedges. So if we think the bond market's going to have trouble, we want to own these. We've owned them last year and this year. We switched this year to Boyle, and they've been trading pretty close. So both have been doing the job. But what could make more money? I think Boyle can make us more money if things are going to get really nasty with the war. So that's where we have our cards placed currently. I've been looking for an opportunity to split it in half to have some NRGU, but we haven't pulled the trigger on that just yet. Now we're looking at lumber futures to predict deflation. It did a good job predicting lower oil prices 3 months in advance last May. And now it's telling us again, watch out, we have the right environment for energy costs to fall. But what we really need to do is fix the conflict in Europe. So when is the war going to end? That's the big question. That's the biggest question here to predict energy costs and thus inflation and interest rates. Here's your DXY. So it's at a level where it's starting to really hurt foreigners. So think about all the global debt held by foreigners that have borrowed in the dollar. So it's costing them more and more money to convert their currency into the dollar to pay interest. So it's going to be very, very problematic for the rest of the world. Let's look at the big picture. How high could it go? So in the dot-com bubble, it went all the way to 120. So we need to be prepared for this to keep going up. I believe as long as the war is intact and the inflation's running hot, the dollar's going to continue to rip things apart. So that's what we're facing here. But the alternative is the dollar could crash as low as 70. Now that's where I think you're going to make a massive amount of money in your cryptocurrencies, is a falling dollar. If you've been investing in crypto, get this, it's up 1,000,000% or more. And it did it with the dollar rising for the last 12 years. Can you imagine the kind of money you'd make with a Bitcoin or an Ethereum position and the dollar's rolling over? One of my favorite investors is Jeffrey Gundlach, and he's been predicting the dollar is going to run up, peak out, and then fall. And this is due to essentially a collapsing economy and twin deficits. Those three things combined are going to lead to a weaker dollar. So right now we're in a crisis mode and people are going to the dollar. But as the crisis unwinds, energy costs come down, things normalize. We don't have the strongest economy. We're running massive deficits on both sides. We're importing more than we export, and we're spending trillions a year that we don't have. It's going to overall weaken the currency. Now, we've gotten most of Asia and Europe to stop using the dollar for energy trade due to sanctions on Russia. So our long-term forecast on the dollar is going to weaken. Here's the yen and the yuan weakening against the dollar, driving that up. But think of that as money printing, okay? So it's going to create more inflation and make the value of everything go up. In this chart, we're looking at our three favorite cryptocurrencies. So we like Bitcoin, that's in our safe growth strategy. We play it with GBTC. We like Ethereum in our high risk portfolio, ETHE. We do have a private equity fund playing a super aggressive cryptocurrency called Polygon. That's my third. If you're looking for the most volatility, the greatest potential return, but you got to be willing to hang on to the downside suffering, Polygon. You can see it has absolutely smoked the returns of Bitcoin and Ethereum by major moves. We're talking when Ethereum had a 80% return, Polygon pushed to a 680% return. So it just gives you some perspective of how much money you could make if you could pick the right crypto. And so what is Polygon? Well, if you know Bitcoin, then you should know what the Lightning Network is. If you know what Ethereum is, well, Polygon is the Lightning Network for Ethereum. And that's why we are very bullish on that asset. Okay, in this chart, we're trying to see, is there an alternative asset for the environment we're potentially entering that could help reduce volatility in our cryptocurrency account? So right now we're hedging against inflation with oil. We're hedging against deflation with treasuries. We're hedging against a stock market crash with UVXY. Would silver possibly help further reduce volatility and generate strong returns? And so what we've been noticing in general has been a inverse correlation between gold and Bitcoin. So just a leveraged version of gold is obviously silver AGQ. So we haven't pulled that trigger yet. I'm not so sure we're hitting a stagflation environment, but at least in this little segment from February to current, a bit of an inverse correlation. That's what we're looking for. How can we have a basket of assets that we believe will go up together over time, but just not at the exact same moment? And that makes us feel a lot better at night because we don't have these big swings in our portfolio every day. Okay, this chart, let's add FAS. Great comment from the crowd today. So there's really two assets that should be going up with interest rates going up. It's NRGU and FAS. NRGU is your big oil and gas companies times 3, the top 10 biggest, and FAS is a leveraged bank product. So if interest rates are going up, we'd expect both those to be going up. But what the hell is going on here? We got interest rates rising to the point where everything's crashing. We got the NASDAQ. So we would expect the QQQ, that's the candlestick, to go down if the yellow line's going up. To see the oil and gas companies expecting lower revenue because the energy costs are too high, pushing their stocks down, and to see the banks freaking out about these interest rates crashing, that is not a good sign. So let's look for something to drive these rates down and save the markets next week from Jerome Powell on Wednesday. Okay, why do we invest in emerging markets? Everybody's been bitching and moaning about my bad timing on emerging markets. So let's just look at that. Boy, was I off for a year. Look at that. While the US stock market went up, emerging markets have just been getting slaughtered. And the most common request has been, can you get me out of emerging markets into something else? So we've had the rising dollar for that year. Let's go back in time though. And also I want to point out Jeffrey Gundlach, Ray Dalio, some of the big investors of our time, both running $120 billion funds, are both predicting a repeat of this. What is this? This is emerging markets making almost 10 times the return of the US stock market after the dot-com bubble. Okay, we had a falling dollar in this environment. Okay, so this is really, if you study Jeffrey Gundlach and Ray Dalio, they put out lots of education. In general, they see a stronger Asian economy over the next decade than North American. Okay, in every respect. And so this is the predictions that you're going to get 10 times the return out of emerging markets than US stocks, and that we're very close to that moment in time. Okay, check out the response to the Chinese rumor they're going to talk to tech companies. You got this massive jump in Alibaba and Tencent. What is that return? Since the 28th, so that's yesterday, we've seen this skyrocket up as high as 17%. So some wild volatility. Now that's nothing if you were holding from the top. These suckers have been crushed. So we're comparing Taiwan Semiconductors, possibly the most important company in the world, the highest tech chips globally. China wants Taiwan. It's going to be a massive war when they invade. I do not predict that happens anytime soon, to be clear. But look at the damage that's been done to Chinese tech companies. So buy the dip is what we're saying. So Alibaba down 63%, Tencent down 51%, Taiwan Semiconductors down 31%. Okay, Europe, with safe growth, the main philosophy is to diversify capital to reduce risk in any single asset. So we are very stubborn about following through on that philosophy. When we do look at the breakdown of the safe growth portfolio, which returned 25% last year, it's down 10% this year. It's using leverage products. So When you realize we're using 3 times leverage, we're doing pretty damn good, especially when the market recovers here. So we have a position in Europe, and it's been pretty boring. The war took it to a new low. It bounced back up. It's crashed back down. But we remain long Europe and Asia because the cost of owning these companies relative to earnings, something like a third of the US companies. So US companies are extremely expensive relative to the rest of the world. Steven's saying, why did Alibaba? The premier Liu Hu or Ha is meeting with the tech companies. Is the headline. Okay, in the safe growth, we are long rare earth metals long term, and we're long uranium long term. We've discussed possibly rotating those positions into NRGU at some point. Haven't pulled the trigger on it. It'd be short term, but rare earth metals creates lithium and cobalt. There's not enough of either of these for Tesla and Apple. So if you want to own Tesla and Apple, realize the profit margins for these companies are going to get choked by the producers of rare earth metals. So if you want to hedge your tech companies, buy REMX. Now, uranium, potentially very, very important to get us to low carbon emissions by 2050 with nuclear power. So that's why we're playing URA currently. Now, copper miners is an alternative, very similar to rare earth metals. We prefer lithium and cobalt compared to copper. There's going to be big shortages. The expectation is the shortage for rare earth metals in the next 3 years is going to be simply put insane. So the cost of lithium has gone up something like 10 times in the last 2 years due to this inflation. Just mind-boggling. But the real constraint is expected to hit. So we're looking at the growth of electric vehicles as a primary driver of lithium demand. And with this growth in just Tesla alone, about doubling every year, that becomes a huge problem over the next 3 years. So we're very bullish on REMX for the long term. Okay, gold to silver. If we see gold leading up and silver is being slow to catch up, easy scalp trade. So I'm looking at silver as a way to hedge our Ethereum. I'm also looking at this a scalp trade if we see gold jump up, but silver's taking a while to get the bid. So there's a little bit of such a scalp right there. Okay, but stagflation. We got 10 million jobs open. We got 5 million people who want to work, and the jobs keep pouring in. So I'm not so sure we're going to have a dead economy anytime soon. Sure, we're seeing earnings slow down. We got Amazon crashing, Google crashing, but that was just from extreme expectations. Big picture, what are we looking at in the market? Labor force participation is rising rapidly, still below Trump's record, but it's going up. Banks had the biggest increase in loans month over month since the pandemic began. So that's not looking bad. Consumers are not scared to borrow. They just borrowed more money than they ever have in the last year, $41.8 billion. And thus, the US consumer continues to drive the market higher in terms of total retail sales hitting a new high. Now, is it slowing down? Sure. So that's why we're seeing these stocks reprice here. US balance of trade, 2 big prints, negative 89 billion, 2 months in a row. So we're sending dollars out to bring in US goods at a negative trade deficit that's at record levels. While we're running massive twin deficits on the, we're expanding debt by at least $1.5 trillion this year. It's probably run at 2 trillion. Okay, we had a huge slowdown in housing sales by 10%, but big picture, we're still selling houses at record pace. And there's a very small inventory at this point. So yes, everything's slowing down, but are we completely crashing? Not so much, maybe except in China, but are they doing this on purpose to drive their import costs down? So the Chinese PMI went negative below 50s negative. They stopped buying stuff. Let's look at imports first. So the last 2 months, they really slowed down buying stuff. And then they go shut down the whole damn country. I thought the COVID was over, but all of a sudden China locks down half the damn country. So some very odd surprises this year. But it looks like they're getting ready to reopen. So we'll see what happens to energy costs when they do that. But I believe this was done to help drive down energy and all the imports that they buy. But look, they really did not like the costs in February at all. Okay, so we're done printing in the US. We'll see if they're going to really start doing quantitative tightening. Let's just review the balance sheet history. So from 2016 to 2018, Bitcoin and stocks in general did really, really well. But 2018, when they announced the quantitative tightening, interest rates kept going up and everything started to crash. So the big question here for me, because we're now going to potentially start doing rate hikes and quantitative tightening simultaneously, is this question and only this question. Are interest rates going up or down from here? And do we have a 2016 scenario coming up, or do we have a 2018 scenario coming up? My expectation is interest rates are going to come down due to the inflation in the market liking the tightening. So we will see. We will see. And I'll try, maybe next week, I'll get the balance sheet lined up with the interest rates so we get a feel for that. But I'll just really make it simple, what happened from 2018 until everything had crashed was interest rates kept going up, up, up. October of 2018, the 10-year hit 3.5%, and the US market was the last one to crash. Bitcoin crashed right away, then emerging markets, then Europe, and then the US market. And interest rates were going up the entire time. So that's the only question we really care about. Where are interest rates going from here? And I believe we're really very, very close to the peak interest rates. And today we close TLT at 119.45. So a good chance we do a trade alert Monday. I kind of want to add some TMF and some FNGU and maybe pull back on some other positions. So we'll take a look at that. Okay, other banks are printing money. This chart shows you a bunch of European assets hitting $9 trillion nearly. Okay, great. So that is our outlook on the market. The rest of the video is only for paid members, where we're going to go through the exact asset allocation per unit of both our safe growth strategy and high risk strategy. So if you don't want to miss the trade alert, call Dean, upgrade 505-322-7515.